The Japanese consumer market presents a strict macroeconomic paradox. It features a rapidly aging population and a total consumer pie that is objectively shrinking. This line chart tracks Japan's aggregate retail channel market size over the past 2 decades. The trend line is flat to negative, with current sales volumes sitting below the levels recorded 20 years ago. But this stock chart overlays the equity performance of specific Japanese retailers over that exact same period. While legacy operators like J-Front Retailing declined alongside the broader market, retail outliers like Seria and Kobe Busan experienced explosive upward trajectories. The widening delta between these equities is stark. Over the last decade, these two winners outperformed the legacy retailer by hundreds of percentage points. In a zero-sum macroeconomic environment, a company cannot rely on aggregate market expansion to lift its revenues. Equity growth is generated entirely through operational architecture. A common institutional assumption is that an aging population automatically creates a highly profitable silver economy, guaranteeing an endless boom in elderly care and consumption. The Japanese funeral industry serves as the ultimate test case for this thesis. The absolute death rate in Japan climbed steadily from under 1 million in the year 2000 to nearly 1.4 million by 2019. Total demand for funerals predictably increased, but the sector's profitability did not track with it. A secondary demographic effect took hold. As average family sizes shrank and the wealthiest generation aged out of the market, surviving families aggressively downsized the scale of the services they purchased. This widespread downsizing caused a collapse in average revenue per user, a metric that tracks the total amount of money a business extracts from each individual customer. The silver economy inevitably degrades into low-margin, scaled-down services, forcing investors to look elsewhere for true consumer returns. A shrinking population does not immediately trigger a consumer collapse. Instead, it creates a severe labor supply shock. In Japan, the year 2012 marked the critical inflection point where the labor pool tightened to the point of structural scarcity. This deficit created immediate leverage for new workers, forcing a massive, sustained spike in the employment rates of recent university graduates. That exact same labor squeeze drove a parallel structural surge in female workforce participation, drawing millions of women into formal employment. This labor shortage created a highly targeted consumer base, armed with independent disposable income, shifting the true locus of retail spending away from retirees. The discount retailer Seria engineered its 100 yen store model specifically to capture this newly employed female demographic. They introduced a store format called Color the Days, pivoting away from low-margin basic necessities to prioritize higher-margin DIY goods, cosmetics, and self-care items. Targeting a newly enriched demographic drove their top-line revenue, but surviving a national labor shortage required brutal internal cost control mechanisms. This stacked bar chart visualizes Seria's employee ratio. To suppress operating expenses, they maintained a workforce of 95% part-time and temporary labor. By strictly limiting full-time hires, Seria kept average corporate wages completely flat, neutralizing the macro pressure of Japan's labor shortage. Seria's compounding returns are the direct mathematical result of pairing high-margin demographic targeting with an ultra-flexible, low-cost wage structure. Kobe Busan took a different approach to the value-conscious consumer, deploying a hard discount supermarket model focused on frozen and bulk foods. In a zero-growth market, simply lowering shelf prices destroys corporate margins unless the underlying supply chain is entirely disrupted. Kobe Busan aggressively acquired domestic food factories and agricultural facilities to bypass external suppliers. This area chart tracks the expansion of Kobe Busan's private brand, or PB, products. PB refers to inventory manufactured directly by the retailer. By bringing production in-house, they pushed their PB products well past the critical 30% inventory threshold. The second half of their architecture avoided heavy physical retail assets by expanding almost exclusively through a franchise or FC model. Because individual franchisees bear the localized operating expenses like rent and floor staff, Kobe Busan scales its corporate revenues rapidly without bloating its own balance sheet. Vertical supply chain integration combined with capital-light franchise scaling provides the definitive blueprint for profitable discounting. By contrast, legacy department stores like J-Front Retailing completely mispriced this macroeconomic shift. They maintained luxury premiums, pricing standard apparel up to 5 times higher than value competitors like Uniqlo, even as the broader Japanese apparel market contracted. Operationally, they retained a bloated workforce of full-time employees with inflexible, high fixed wages, even as foot traffic into their stores dropped. This bar chart measures total asset turnover, how efficiently assets generate sales. J-front retailing remained trapped below 1.0x, in stark contrast to Seria, well above 1.5x. A sub 1.0x ratio means physical assets consume more capital to maintain than they actually generate in sales. Holding heavy retail assets, premium inventory, and fixed labor costs in a stagnant demographic guarantees irreversible margin compression. When the macroeconomic tide goes out, top-line demographic growth can no longer mask structural inefficiencies. This illustrates the financial trap in an aging economy. Pairing high prices and fixed expenses with a stagnant demographic guarantees capital destruction. Conversely, generating equity returns without aggregate growth relies on a hard discount model, a private brand supply chain, and a capital-light franchise structure. Demographics are not destiny for the individual firm, but they are unforgiving to legacy operational models. True resilience requires stripping fixed costs, controlling the supply chain, and meticulously targeting the secondary labor shifts created by demographic collapse.